In November 2022, Bitcoin was around $17,000. By March of 2024, it climbed to nearly $68,000. And at the time of this recording, it's trading near $118,000. Bitcoin's price moves up and down. That's part of the game. We've become used to that. But the key mistake that people make, especially when looking to access the value of their Bitcoin, is to sell it. Every time you sell, three things happen. First of all, you give up ownership of a scarce asset. Secondly, you trigger a potential tax event. And thirdly, you lose all of the upside your Bitcoin was built to deliver. Now, most people keep making this mistake, not because they want to, but because they think they're selling their Bitcoin is the only option they have when they need cash. But in this video, I'll show you how to use your Bitcoin like an asset, not like a piggy bank, by borrowing against it safely, even if you don't own a full Bitcoin. And I'm going to prove all of this to you by showing you, one, why selling your Bitcoin could be a costly mistake, two, how borrowing lets you unlock its value without having to sacrifice future gains, three, why paying interest isn't always an expense or even a loss, and four, the mindset shift that helps you grow and protect your Bitcoin for the long run. So, what is the most critical mistake that Bitcoiners make? That mistake is selling for short-term cash. Here's the scene. You need $5,000 for an unexpected expense. What do? You sell some Bitcoin, and sure, you get some cash. But that move comes with strings attached. Let's think about that. First of all, there's the tax hit. You might pay capital gains. Then, if Bitcoin rallies, you've missed out on the upside. Plus, there's the emotional regret. Watching the price go up after you sold and regretting that you no longer have access to that scarce asset. All in, this becomes a quick cash out that becomes extremely expensive. Now, selling Bitcoin feels like solving a problem, but in reality, it's often just swapping one problem for a sneakier one. So let's explore the true cost of selling. We've been thinking about this, and oftentimes I like to refer to this as the cost of selling iceberg. There's one cost that we're all very much aware of, and the other cost oftentimes exists below the surface. So if we look at this graphic we have here, the first cost is above the waterline. We're really thinking about this. This is the immediate cost that you have when you are selling, and it is a tax implication. You're getting hit with capital gains, especially if you sell within the first 12 months, because capital gains are often taxed like regular income. The second cost is really that of the future cost. This is giving up sort of the potential upside that you would experience by holding on to the asset for a longer time period. In fact, if you look back at the data for Bitcoin, if you miss just 10 of the best days in Bitcoin over a 5-year period, your returns could drop by over 60%. BTC tends to move fast, and missing a rally can mean watching thousands of dollars slip away. And the third cost is what I referred to as emotional cost. This is both the regret and the scarcity grief that you have. When you sell, you give up ownership of a scarce asset. There's only ever going to be 21 million Bitcoin minted. And the cost here is not just financial, it's psychological. It's the pain of trading something away that's rare, and long-term for something short that might even be mundane. So, what's the smarter alternative? Instead of selling, imagine borrowing against your Bitcoin. You lock up some BTC as collateral, borrow fiat, and you still own the underlying asset. Sounds better, right? You get liquidity without giving up the future upside, all while avoiding potential tax implications. Now, let's get into the key concept here. That is that interest isn't really a cost if you put the money to work, and or the appreciation of the asset, in this case Bitcoin, outpaces your cost of borrowing the capital. Picture this. You borrow $10,000 at 10% to invest in something returning 15%. After a year, you've earned $1,500 and paid $1,000 in interest. That's a net $500 gain. Plus, your Bitcoin stack could have gone up in value too. But if you'd sold the BTC instead, you'd lose out on any price appreciation in addition to having a tax liability. So let me give you an easy way to think about this. I refer to this as the borrowing intent matrix. And if we think about this across two axes, one axis is going to be your purpose of borrowing the money. On one end of the spectrum, we have consumption, and on the other end of the spectrum, we have investment. And the other axis is going to be your time focus. What is your time horizon for the use of the money? Is it short term or is it long term? And for a lot of people, if you start off in sort of the consumption mindset and in the short term time frame, when you borrow, you can often get into a debt trap. You can end up having high interest costs and low return debt. You're just not able to either make the right purchases, maybe they're discretionary, but in particular, you have a shorter time period that just doesn't doesn't allow you an opportunity to recoup any of those costs that you might be incurring. Now, that may not be bad all the time, but it has been shown, and often is the case, it can lead people into larger and longer term debt. The second frame, again, thinking about short term, but on the investment side, this could be one where we could be thinking about this as the hopeful gambler. Like, you're borrowing the money for an investment, but your time horizon is so short, you're not necessarily giving yourself a realistic chance of the upside or the appreciation or the yield that you might be hoping for. And then if we start to think now more longer term, we start to get an area where history has shown and the data proves out that you can be very effective at leveraging your assets. In the consumption quadrant, we can think about long-term consumption really being a mindful spender. A lot of people are borrowing against their Bitcoin in this model, in this sort of mindset, to really either have an income supplement or even retire on Bitcoin. They're pulling small amounts of money down on an annual basis, and they are really being a mindful spender with the liquidity that they're able to gain access to. And then if we move into an investment in a longer term time horizon, we really view this as being a strategic leverager. Here, we're using the cost of the interest to build lasting value. We're allowing a long enough time frame for the underlying asset to have the potential to appreciate, in addition to the opportunity to invest the capital we borrow into other assets that might generate additional yield, such as stocks, bonds, or even real estate. So I encourage you to think about your Bitcoin a little bit like a rental property. You wouldn't sell your house just to pay a bill. You'd rent it out instead. The house would keep appreciating and the rent would cover your needs. Borrowing against your Bitcoin works in a very similar way. You keep the asset, you tap into the liquidity when needed, and you still benefit from the upside. If you're ready to use your Bitcoin smarter without selling, you can learn more at saltlending.com, or just click the link below for extra resources and information. Make the move that protects your future gains. I appreciate you watching, and if this has helped you rethink how to use Bitcoin, hit the like button and subscribe, and share with other Bitcoiners. And if you want more advanced BTC strategies, drop a comment with your questions below, and I'll see you in the next video.